Compounding is one of the most powerful tools available to retail investors. While many people have heard of it, very few actually manage to build wealth through it. Why? Because most investors don't truly understand how compounding generates wealth, let alone how to fully leverage its power. The formula is simple. The wealth you end up with depends on just three variables: initial capital, rate of return, and the length of time you stay invested. Let's begin with time, or the length of your investment, because it's the core engine that drives the explosive power of compounding. Imagine you start with $100,000 and earn an annual return of 10%. It takes 8 years to double that to $200,000, but reaching $300,000 takes just another 4 years. Getting to $400,000 takes only 3 more. And from there, each additional $100,000 comes faster and faster. Once you reach $1 million, making another $100,000 will take just 1 year. That's compounding at work. It takes time to build momentum. In the early years, growth feels slow. It can even make you question whether it's worth continuing. That's when most people give up. But if you push through that early stage, compounding begins to accelerate. The longer you stay invested, the stronger it becomes. You should know, even Buffett made 99% of his fortune after the age of 50. For most people, the actual investing lifespan is only about 30 years. Many start working around age 25, and some don't begin investing until 35. By the time they retire at 65, that's roughly a 30-year window. In the world of compounding, time is your most valuable asset. And because time is limited, the earlier you get started, the greater your results will be. Each year you delay can mean missing one full doubling cycle. But even among people who start early, many still don't build much wealth after years or even decades of investing. Why? Because they never took investing seriously. At its core, investing is a business where money makes more money. The more capital you have, the easier it is to grow it. But many people don't treat investing as a real business. They only commit small amounts. Take a look at this. If you invest just $10,000 and earn 10% annually, it takes 25 years to grow that into $100,000. Sure, that's a 10x return, but in absolute terms, it's still not much. Most people wouldn't wait 25 years just to earn $90,000. This is why starting with too little capital can push people toward gambling behavior. If your starting amount is small, you feel pressured to chase extremely high returns to get meaningful results. But in reality, high returns always come with high risks. Now, let's say you start with $100,000 instead. At 10% annual return over 25 years, you'd end up with about $1,080,000. Still think that's not enough? Don't forget, you can keep contributing using strategies like DCA, the dollar cost averaging method I talked about in a previous video. If you haven't seen it, check out the link in the corner. Now, if you start with $100,000 and invest an additional $1,000 each month, after 30 years you could end up with around $3.8 million. That's a return worth getting excited about. So if you're serious about investing, don't just put in pocket change. Starting with too little money slows down compounding, messes with your mindset, and pushes you to chase high-risk bets, most of which don't end well. Now you might say, 10% return is too low. Someone I know made 30% in stocks or 100% in crypto. Sure, in the short term, some people do hit those amazing returns. But what about over 30 years? Looking at over a century of US stock market history, the long-term average return is around 10% a year. That's a return most investors can get without doing anything extraordinary, and it's also the easiest goal to achieve. But once you go beyond that 10% mark, every extra 1% in return becomes significantly harder to achieve. Even Warren Buffett, one of the greatest investors of all time, achieved an annualized return of around 20%, and that's considered legendary. But many people, especially younger investors, scoff at 10%. They believe they're different, and they like to chase high-return assets hoping for overnight success. But here's my advice. Don't try to beat that 10% too easily. High returns always come with high risk, and countless people have paid the price for chasing them. Learning to accept 10% and accepting that you're an average investor is one of the most important mindset you should have. When you're young, sure, explore, try different investments, maybe even grow your capital faster. But give yourself a deadline. By age 35, it's time to become friends with compounding. And for most people, investing $100,000 by age 35 is not out of reach. If you can stick with it, this wealth curve will become your clearly visible future. You don't need to be a genius or take huge risks. You just need to keep investing and let time do the rest. That's the philosophy I want to share. Investing is simple, and anyone can do it. If that resonates with you, then welcome. This channel is made for you. Subscribe now, and let's grow our wealth together with the power of compounding. Thanks for watching, and I'll see you in the next video.